Welcome to another episode of the Michael Yardney podcast. Today I want to talk about something that's really flying under the radar, but it shouldn't be. Imagine being taxed on money you haven't actually earned. Not on rent you've received, not on a capital gain that you've banked, but just on the increased value of an asset that you still hold. Sounds crazy, right? Well, that's exactly what the federal government's proposed new tax on superannuation above $3 million aims to do, taxing unrealised capital gains. And while they say it's only going to affect a handful of wealthy Australians today, the truth is that because the $3 million cap isn't indexed to inflation, could very well affect many more of us tomorrow. Worse still, it sets a precedent. If the government can tax you on unrealised gains in your super, what's going to stop them doing the same outside of your super, to your investment properties, to your business, to your share portfolio? So today, I've asked Ken Race, Director of Metropole Wealth Advisory and Australia's leading property taxation strategist, to join me for what I believe is a very important discussion. We're going to unpack exactly what this policy means, why it matters far more than most people think, and what smart investors should be doing to prepare now. Trust me, this isn't an episode just about superannuation. It's about the future of taxation in Australia. So whether you're a seasoned investor or just planning for your financial future, you need to understand what's really going on. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Ken.
Hi, Michael.
Now, Ken, there's lots of noise out there at the moment, but one recent policy proposal really stood out to me, and that's because it's going to change the way Australians build their wealth, possibly for generations to come. And Ken, what I'm talking about is the federal government's plan to impose a higher tax on super balances over $3 million. Now, sure, that may sound like it's only going to affect a small group of the ultra wealthy, but in my mind, there's a catch to this. It isn't just about the rate of tax, but it's about how their tax is going to be calculated. And in my mind, the alarming part is that it's going to include tax against unrealised capital gains. So maybe to start things off, in simple terms, Ken, what is the proposed tax change that I'm talking about, that we're going to be talking about, and what does it involve?
Yeah. Before we start, maybe I'll vent first. And to me, this is malware on your financial future. It's a
Wow.
ticking time bomb waiting to go off sometime in the future.
Now, if I could interrupt you, Ken, just to remind people, even though there's a disclaimer at the end of the show, we're talking about superannuation, we're talking about finances. This is general information. We don't know your specific circumstances. And even though Ken's an accountant and a licensed financial planner and able to give advice, that's not what we're doing at the moment, are we?
That's correct. So thanks for bringing that up again, Michael. So this is just information,
But
which everyone should
malware,
seek.
I like the
Malware.
name. I like the term. Well, I don't actually, but
No.
I get the analogy. So please, I'm sorry I interrupted you. Please go ahead.
No, that's okay. So it's proposed, but I think it'll get through now, given the different people who have got into Parliament. It's a tax on unrealised profits in your super if your balance is over $3 million. So they'll only tax proportionately the amount over 3 million. So if you got $3,000,001, it'll hardly affect you. But if you got 6 million, 50% of the growth will be taxed at the 30%.
Now, if I get it correctly, Ken, this is even if you haven't actually sold your assets.
So they'll do a valuation at the end of the previous year. They'll do it at the end of this financial year. And if there's a growth, and they'll do adjustments for contributions and withdrawals, and then determine the capital growth. But the issue for a lot of assets is how will they be valued? And that's going to be a sticking point, particularly farmers who have got their business in the super fund, other people who might have assets in the super fund who are capital growth assets, and they'll be taxed along the way as opposed to waiting till it's sold and then you actually know. And the insidious part of that is As the assets grow, you'll pay tax, but when they fall, you don't get money back. So it could be on the never never you've paid tax, and then if that particular asset plummets in value, tough luck.
I know some people are going to say it's just Robin Hood. It's taking from the rich and giving to the average Australian. After all, $3 million in your self-managed super fund's a lot of money. But from what I understand, this is really a significant departure from existing principles. Forget the amount at this point, taxing you on profits you haven't physically been able to spend. If your investment property goes up in value outside your super or your shares do, you don't pay tax, do you?
Yeah, it's only within the super. And some countries, Germany, Sweden, Norway, have tried to tax all assets that have grown, and they've ended up having to retreat. So the issue for me, as well as all this here, it's income tax. So in super, there's a tax on normal income, 15%, a tax on capital gains of 10%. So they've just taken the 15% and doubled it. Even though you got a capital gain, you're paying the tax as if it was normal income. So when we look long term, and that's why I use the term malware, anyone who's just starting off their working career, early 20s, I'm going to be in super for the next 40 years. Just their super contributions is going to give them a balance well and truly above the 3 million. So it's effectively going to capture nearly everyone who works, can I say, a full working life. So it's just going to sneak up, and it'll be more and more people caught as the years go by.
Well, my concern is it's tax on money you won't necessarily have. So if you have shares in your superannuation, you could sell a small parcel of shares or ETFs or something. But if a lot of people have property there, now you should have a blend. And again, this is not advice, but sometimes assets are illiquid.
Correct. And if you invest in your super fund, call it a startup. You might get some improvements over those first few years. You've paid your tax, but then that industry might collapse or that idea might collapse, and then your investment is worth nothing. So the other part of this is while it says it's only affecting a small amount of people, it actually excludes a large part of the population. So politicians, public servants, judges. So they're either explicitly excluded
Really?
or, yeah, so the law excludes them at the state level, and at the federal level, they're actually not caught. So it doesn't even treat everybody the same who are in the same boat.
Wow, I didn't know that. That's interesting. It's also in some ways a tax on inflation, isn't it? One of the points you made a moment ago is that $3 million sounds like a lot, but if it's not going to be indexed, and that's what they're saying. I remember when I first had 20,000 in my self-managed super fund way back in the 1970s. That was a huge amount of money, and I thought, I really would rather have access to my funds now and not put it in super. But my accountant at the time, Stan, was very smart and said, be patient, delayed gratification. And boy, has the amount over the time increased by so much that I wouldn't have ever imagined then in my 20s that I'd have millions in my super fund today.
That's right. It's like bracket creep,
Yeah.
where we do get some benefits every now and again by the various federal governments. So this is bracket creep, almost as a most insidious. So if we're paying normal tax on money you've actually earned, call it 15% on those large balances, plus a 30% on unrealized, you could find yourself in a circumstance where you've actually paid 45 cents tax in your super on those amounts over 3 million, depending on the mix of assets you've got.
So is one able to sell assets in the super fund if you get the money to pay the tax if you're not in pension mode, if you're in your 40s or 50s?
No, so the super fund can sell assets, and then you have to make special representation to the ATO to withdraw that amount, the equivalent amount, to pay the tax. So if you're in pension stage, you've met conditions of release, then you can take the money out by selling assets and then paying the tax. And you've only got a fairly short window to make the application to the ATO to withdraw funds to pay the tax if you haven't met that condition of release i.e., you're still not in pension stage.
Well, the other thing is elsewhere outside super fund, you could borrow, you could you use your offset account, you could take a loan against assets that you've got. You can't do that easily in a super fund, can you?
No. And while you may be able to lend money to your super fund, there's very strict rules for that. And it's probably not deductible if you've borrowed it to put into the super to get the equivalent cash to get out. So you're like double whammy.
So, in some ways, maybe going to force people to sell assets or borrow to pay tax. That's not easy. It's going to, in my mind, also create a complex valuation nightmare. I remember before the current capital gains tax system, when you actually had to work out what capital gains was, it was very complicated. Where do you start? How do you value assets that you haven't sold? That's going to be a nightmare.
Yes, and the government at the moment is hiding behind the concept that only a few people are affected. But as I showed earlier in our interview, it's going to get more and more people, and eventually it'll capture nearly everyone. And there is a couple of taxation imposts at the moment that aren't indexed, that the government have had for 15 years, 20 years. So I don't think we can rely on their being a good person and eventually indexing it.
Yeah.
This is money that they know they're going to need more and more, especially as we've seen the latest budget showing deficits over the next 40 years.
Yes.
So it's really creating cash to start paying for that in the future.
Now, I've spoken to a couple of people about this, Ken, and they're saying, oh, this just makes the tax system fairer. I guess fairness depends where you stand. And according to Treasury at the moment, just 80,000 people are expected to be affected at first. But that's today. And as you said, in 5, 10 years' time, it could be without indexation, it could be hundreds of thousands, especially those who've been prudent, who've invested in property, diligently contributed to their super, because that's what we've been told to do so that you don't put extra burden on the pension system. And in the longer term, as you say, it's likely to affect everybody. But these property investors have already paid income tax. They've already paid, in some cases, capital gains tax, GST, land tax, stamp duty. They're not dodging their applications. They're just being squeezed harder every year, Ken.
That's right, harder and harder. We've got to be careful. The legislation starts on the 1st of July. So when it eventually goes into Parliament for approval, it'll be backdated. But it won't actually come into effect to the end of this current financial year, which is 30th 2026.
Yep.
People have got some time now to talk to their financial planner this financial year and all of next year. So that'll allow them to do some, can I say, some superannuation tax management, which we've never had to do before. So this is the first time that a government has introduced in Australia a tax on unrealised earnings.
Yes.
So this is potentially the edge of the wedge, where if they see that people accept it or don't complain too much, it could easily blow out into other areas outside of super, wealth taxes, death duties. Again, they're going to say maybe at the high end it'll only affect a few people, but it'll eventually capture a lot of people.
Well, that's my concern. It sets a dangerous precedent for taxing unrealised gains. Again, we accept the fact that you've got to pay tax when you make a profit, make a gain that you can use, you sell something. But for unrealised gains, that's going to change the way people invest.
Absolutely, particularly in startups, people who want to put their business, particularly farmers, in their super fund. It's going to have unintended consequences, and people now have to be very wary of this because it's a very long tail.
Well, it sounds like people are going to be penalised for holding appreciating assets, which is the way a lot of Australians have done things. So that makes it difficult. But it's ironic that what I just learned from you, that certain people have been excluded from this. What was the basis of that?
Well, at the state level, there's actually legislation that would exclude this type of taxation. So that's the state government, politicians, judges, etc., etc. At the federal level, this until now, unless it's changed, is at the discretion of the treasurer. So it's not built into the legislation that it will apply. So as of today, the Prime Minister's excluded.
So I guess this is also going to undermine investor confidence and in some ways business confidence, Ken.
Yes, and look, I was a bit out from left field. I started my superannuation when I was 17, AMP Super.
Yep.
Had I known that, this was going to be the consequences, I think I would have made some slightly different decisions along the road. And I think this will force people to rethink that super strategy. Because at the end of the day, super is something there that takes pressure off the government to fund retirees. And yes, there are tax concessions, but you have to lock up your money. You can't invest in just anything. You can't refinance. So there are a lot of limitations. So the lower tax concessions is almost a bribe or a payment to keep your money in for a
Yes.
long time with restrictions on your investment strategy.
Well, to be blunt, that's how I saw it, and I know that's how a lot of other people uh, saw it. And I guess in some ways we were led to believe that while rules will change and taxes will change and interest rates will change over time, there was the belief, the understanding that superannuation wouldn't, or the taxation of superannuation wouldn't. But I guess now it's a dangerous signal to investors that rules can change mid-game. And the other one that I guess concerns me is that success can be punished. We're seeing this in other areas as well with the various state governments, and particularly my state government in the latest Victorian budgets, putting extra levies on everybody, extra land tax on everybody. It's going to mean some people are going to say, it's too late. I don't want to invest in property. It's too hard. What would you say to them?
Look, the benefits of property for most people, if they buy the right property, they've got the right advice, is leverage. So they've been able to turn a small amount of cash, their deposit, and leverage it into a much larger asset. So they're actually building their asset base much faster than otherwise. And property is one of the few assets that you can do that with. And yes, you can get loans for shares, but the loan to valuation ratio tends to be a lot lower. There could be call ups, if the shares go down. And at the end of the day, everybody needs property. And certainly we see a shortfall in the number of properties in Australia. So we've got to assume that there's almost always a demand for a property, even though it might go down a couple of dollars, at the different times of the cycle. So property, I think, is still for a lot of people a very good investment if they buy the right property with the right advice in the right structure to help them grow the asset base more than they would have had they used savings alone.
I'd agree with that. And again, there's lots of different entities in which you can own property. And I know that's what you and your team at Metropole Wealth Advisory specialise in. So while we can't give individual advice, let's just talk generally. You can't control the tax policy, but I guess we can control our strategy and what we do. What are some practical considerations people listening to this, even if they're not affected by it today? And to be blunt, most people listening to this won't be, even though I know a couple who regularly listen will be. But what practical moves would you suggest they consider?
I think they need to seek advice if they're in that pension stage,
Yes.
because they've got this window for the remainder of this year and next year to maybe implement some strategies to help reduce the impost of this. If they're in pre-pension stage, then I think the throwaway line historically of just maximize your contributions, whether they be pre-tax or post-tax, will need to be reviewed. And I think we need to now look at alternative investment strategies outside of super that effectively get you a very similar tax benefit without the restrictions.
And there are a number of different structures and entities you can use. And I know recently at Wealth Retreat, we were in a room of very high achievers, some very successful property investors and business people. But even for them, you suggested a range of strategies, a range of structures. There isn't one size fits all, is there?
That's right. And I even had one of those clients who signed up to our service the other day and they brought their accountant along, which was perfectly fine, but they're one of the larger mid-tier accounting firms. And they didn't have at close at hand the strategies that we spoke about.
Sure. Well,
So
maybe we could just take a quick break and explain what you meant by that, because at Metropole Wealth Advisory, even though you are an accountant and there are people with economics and accounting degrees as part of the team, we don't want to be people's tax accountants. What do you and your team do?
we tackle the issue of wealth creation at a very holistic level. So, how to grow, protect, and pass on your wealth. And that means you need to look at a broad range of financial and professional inputs. You need to look at tax, you need to look at structures, asset protection, estate planning, super, the list goes on and on and on. And to have a look at that under the one umbrella makes sure that you don't do something on the one hand that is detrimental to the other. It's taken in consequence. So we help project manage these other professionals so that they implement strategies that complement the whole as opposed to just their professional focused area.
Interesting. So I guess you started to say it a moment ago, cookie cutter approach doesn't work, shouldn't be done. And the other thing is maybe it's worth just revisiting what your retirement strategy is, because if you're going to get taxed more along the way, it's possible that you're going to need a bigger asset base. Now, when we speak with clients, we say all along that when you retire or slow down or start living off your property portfolio in the future, we know there's going to be a number of changes to governments between now and then. We know there's going to be changes to interest rates up and down. We'll probably have another recession at some stage along the way. So one has to own the best assets you can in the most flexible structures, because the rules are going to change. But if we're going to get taxed more along the way, I think that's got to be taken into account in your planning, doesn't it?
Absolutely. And that's when this intergenerational wealth transfer strategies come into being. So we do a lot of work with clients of how do I pass that family wealth to the next generation safely and tax effectively.
Well, tax effectively is an important one, because if you leave it too long, I guess if they're changing taxes along the way, don't want to scare people, but it's quite possible that a death tax, some sort of transfer tax is going to come into play in the future. Again, if they're penalising people who've built substantial wealth, and we know that the rich are getting richer, there are going to be more calls for, well, hang on, why don't you tax them at the end?
That's right. And again, the same as unrealized profits are now going to be taxed in super. I think we're seeing a regime or a future where governments, and I don't want to be political about this, are going to need more and more money to implement what they want to do. And
Yes.
therefore, creative bookkeeping by the government to increase their taxes is now going to be if you like, a new game.
Interesting. So I interrupted your train of thought with advice you gave to people. So one bit is to get advice, but get advice from the right people. And if you're wanting to get Ken's thoughts and advice to actually help you with setting up the right ownership structures, even if it's not for super now, or if you're going to start to get in the property market, or if you're already established a property investor. Ken, I know one of the big questions that kept coming up at Wealth Retreat is people had set up their ownership structures incorrectly. They did what they thought was right at the time and now find they own a lot of things in their own name, and they're a little bit worried about that. Do you have some structures, some strategies around that?
We do, but it's premised on what is their main objective and priority.
Yeah.
And depending on what that is, there are a few strategies that we can help implement that doesn't trigger all the normal taxes.
So I guess it's worth looking at your ownership structures, learning to diversify them, seeing what options are on the table for you. And they're usually not the sort of information the average accountant gives you. And people seem to get concerned about that, Ken. I know when they speak with you, they say, well, why hasn't my accountant told me that? What would you normally say to them?
I say their accountant probably should know. If you think of the concept of an engineer, you don't go to an engineer to do civics, electrical, whatever. You go to a specialist.
Structural, yeah, there's a whole
Correct,
lot of,
structural engineer.
yeah.
So I think it's the same for accounting. So at Metropole Wealth Advisory, we see ourselves as the specialist working with the local GP, which is your local accountant. So we work then with the local accountant to implement the strategies, and we help them understand how to do the tax returns, etc., etc. Although we don't do the tax returns, we actually advise the local accountant, because it could be a strategy that they've never seen, or they might only see once every few years. So they're not up to date with the most relative and recent changes, and they're not supposed to if they never see them.
So what common mistake do you think people are going to make now when they listen to this, read about this in the media? What mistakes would people be making that you're going to suggest they avoid?
I think the first one is going to be, it doesn't affect me, it's too soon. And then all of a sudden they're well and truly down the track of something, and it's going to cost too much to change.
Yeah.
They're not going to seek specialized advice. The other thing is, I think a lot of people, when they first see us, have a bit of a wariness that because their accountant didn't advise them of something, this might be a little bit grey. We don't do any of that. It's got to be 100% rigidage. The
Yeah.
reason the local accountant doesn't know it or hasn't spoken about it is because they haven't done it enough. They may never have done it. So therefore it's foreign to them, and therefore there's an unease. And that's why they don't know what they don't know they don't know.
Yep. Yeah.
And that's why people come to us either for second opinions, to put in place strategies, but they like the idea of this holistic approach where we project manage, if you like, the implementation of a plan and a strategy, where we're the mouthpiece to these other people. So
And
the
you're
client,
bringing the various disciplines together,
correct.
because often the solicitor doesn't speak to the accountant, doesn't speak to the finance broker. So, Ken, thanks for allowing us to have this deep dive into one of the most significant tax policy shifts we've seen in recent years. And as we've discussed, this isn't just for a few wealthy superannuants. It's about the integrity of our tax system and whether we reward long-term responsible investing or we start to punish it. So if you're building wealth for retirement, especially through property, my advice to you is you need to stay informed, stay structured, and most importantly, seek out expert advice from professionals who understand both the tax landscape but also your personal financial goals. And if this conversation has raised questions about your super strategy or broader wealth planning, why not have a wealth discovery chat with one of our wealth strategists at Metropole? I'm going to leave a link in the show notes, metropole.com.au. Just go to Metropole and have a chat and say that you'd like to have a chat with Ken and his team. There's no obligation. It's just a way of you getting clarity and to start some smarter planning. By the way, if you found today's show valuable, I'd really love you to share it with somebody else who you know who's also serious about securing their financial future. Because, Ken, I think there should be a bit more of a fuss and an outrage rather than us just sitting there and just accepting that they're changing the rules on us.
It's almost like that story, the frog with the hot water,
Yes,
where,
yes.
if it's just a drop here and there, we don't feel it until it's
Yeah.
too late. Whereas if we get thrown into the hot water, we would object and jump out fairly quickly with major injuries. So I think this is a tax by stealth, because while the super system and taxation changes periodically, this is one of the first times there's been an absolute fundamental change in what is caught to be taxed. And that's what causes the biggest concern.
Well, I'd like to recommend and to suggest that we don't allow the government to rewrite the tax laws under the guise of fairness and doing it quietly.
Yes.
After all, I think after what you've just taught me, many skeptics would wonder why many politicians, public servants and judges will be exempt from this or not currently caused under the proposed legislation. What's fair for one's fair for all, I would have thought, Ken.
It should be. It should be.
Okay, well, thank you very much. I look forward to having our next chat real soon on the Michael Yardley podcast. Thanks, Ken.
Thank you, Michael. Thank you to everyone.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today's mindset message is a little bit longer one because I want to explain with you the most important trait I think you're ever going to need to be successful. Look, you've probably heard Warren Buffett's famous advice, be fearful when others are greedy and greedy when others are fearful. It sounds wise, even poetic. And in times of calm, it's easy to nod in agreement, maybe repeat it on a dinner party or on social media. But when fear really grips. When the markets tumble, as the share market did earlier this year, when the property market stumbles, when uncertainty looms, or the news feed or social media is filled with worst case scenarios, how do you actually show up? I know most investors don't lead into the storm, most retreat, most talk courage, but act from fear. And that's precisely what separates those who achieve extraordinary results from those who simply watch on. Now, I remember reading C.S. Lewis. He wrote something along the lines of courage isn't simply one of the virtues, but the form of every virtue at the testing point. Now, think about this. You aren't defined about how you act on a sunny day. You're defined about how you respond when the clouds roll in. It's easy to speak of loyalty, discipline, or conviction when life's comfortable. But real courage, that's who you are when the future is uncertain, when the rewards are unclear, when no one's applauding you, when the risk is real. It's those moments, those testing points where your character is revealed. And make no mistake, life will test you. I've been around the block a few times. I know that. You'll be tested when your investments go sideways. You'll be tested when your business slows or you lost your job, or when you question if the sacrifices you're making at the moment for the future, are they worth it? Or when those around you choose the easy path and you're tempted to follow them. You've heard me say before, do the easy things now and you're going to have a hard time later. Do the hard things now and you're going to have an easier time later. So in today's world, intelligence is everywhere, talent's abundant, but what's truly rare is courage. I mean, with AI now, everyone seems to be intelligent, but as I said, what's truly rare is courage. Someone out there is living the life you want, not because they're smarter or more connected or more privileged, but because they acted when you didn't. They made the call, they took the risk, they stepped forward at the testing point. They weren't fearless. They didn't let fear decide for them. And that's the thing most people don't realize. Courage isn't something you were born with. It isn't. It's something you choose. You choose it every single day. You choose it when you speak up instead of staying silent. You choose it when you invest when others are panicking. You choose courage when you stay focused instead of following the herd. You choose it when you lean in when it's easier to run away. You see, the road to the life you want doesn't really get easier. In fact, it often gets harder as you rise, but you get stronger, you become braver, you earn the resilience required to rise again when life knocks you down. And believe me, it will. And here's what makes the difference. You don't wait for courage to show up. You act and courage will follow you. Just like muscles, courage builds through repetition. Each time you choose to step forward despite the discomfort, you're forming the habit of bravery. The life you want's behind the door you fear to knock on. I think it was Seneca who once said, it's not because things are difficult that we do not dare, it's because we do not dare that things are difficult. Now let that sink in. The challenge in front of you isn't your enemy. Avoidance is. If you're sitting at the crossroads right now, if you've been hesitating on something that matters, let me suggest this. The regret of inaction is always worse than the sting of temporary failure. The fastest way through fear is straight through it, into it. And courage now makes for ease later. So my mindset message to you today at the end of this Michael Yardney podcast is, you may not feel ready. You may not feel qualified. You may not feel confident, but you are capable. So next time life delivers you a testing point, and it will, don't shrink back. Choose courage, because every meaningful life is built on moments where someone just like you dared to show up when it mattered the most. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?